The current trading price for General Electric, specifically the entity now known as GE Aerospace, is sitting at exactly $299.81 USD, significantly up by 11.39 points or 3.95% for the day. If you were watching the ticker right now, you were seeing a massive green candle that completely contradicts the sleepy, low volatility narrative that usually surrounds century-old industrial giants. The market opened with a slight hesitation, dipping briefly, but the buying pressure that stepped in around 10:30 a.m. has been relentless, pushing the stock toward the psychological resistance of $300. This isn't just a random fluctuation. This is a decisive breakout move that suggests institutional capital is flooding back into the aerospace sector with aggressive intent. Most retail investors look at a chart like this and assume they missed the boat, or they expect a company like GE to be a slow-moving, dividend-paying legacy hold that belongs in their grandfather's portfolio rather than a modern high-growth watch list. That is the expectation. The reality is drastically different. What we are witnessing today is the market finally waking up to the fact that GE Aerospace is effectively a monopoly on the physics of flight in the Western world, trading with the momentum of a tech stock but the fundamental backing of real, tangible infrastructure. While the crowd is chasing the latest AI hype or trying to time the bottom on volatile tech names, GE has been quietly compounding, up nearly 72% year-to-date in 2025, and today's 3.95% surge is the market acknowledging that the supercycle in aviation is not a theory, it is a financial fact hitting the balance sheet right now. The curiosity loop here is simple. Why is a 100-year-old engine maker outperforming the flashiest names in Silicon Valley this week? The answer lies in a supply chain bottleneck that has turned jet engines into the most valuable commodity on the planet, creating a pricing power dynamic that almost no other company enjoys. Let's look at the tape and the immediate market mechanics driving this price action. The volume today is significantly higher than the 10-day average, which tells us this isn't just retail traders buying a few shares on their Robinhood app or dabbling in Robinhood fractional shares. This is high-conviction accumulation. When you see a stock of this size move nearly 4% in a single session without a direct earnings release dropping that morning, it usually signals an upgrade from a major desk or a repositioning of funds. In this case, we are seeing the ripple effects of recent analyst upgrades, specifically from Citi, hinting at a price target closer to $386. The smart money, the funds managed by Fidelity Wealth Management or the big accounts at Interactive Brokers trading desks, are likely positioning for a run past $300. They understand that the consolidation phase we saw in late November is over. The stock had pulled back from its highs of $317, shaken out the weak hands, and is now resuming its primary uptrend. To understand why this move is sustainable, you have to strip away the General Electric name and look at what this business actually is today. It is no longer a sprawling, confused conglomerate making light bulbs, MRI machines, and insurance deals. That version of GE is dead. The company trading at $299.81 today is a pure-play aerospace juggernaut. It is the dominant supplier of jet engines for both Boeing and Airbus. Think about that for a second. It doesn't matter if Boeing wins an order or Airbus wins an order. If the plane needs engines, GE or its joint venture, CFM International, gets paid. This creates a heads-I-win, tails-I-win scenario for investors. Today's price action reflects a realization that the backlog of engine orders is so massive, sitting at over $140 billion, that the company's revenue for the next 5 to 7 years is effectively guaranteed. While Tesla stock or Nvidia stock fluctuations depend heavily on the next quarter's sentiment or a new product launch, GE's revenue is locked in by contracts signed years ago. The specific catalyst for today's aggressive buying likely ties into the broader realization that the global supply chain for aviation parts is finally stabilizing, thanks to GE's flight deck lean operating model. For the last 2 years, the narrative was that supply chains were broken, parts were missing, and deliveries were delayed. Investors hated that uncertainty. But recent data, including the Q3 earnings report from October, showed a massive jump in engine deliveries and a 28% surge in services revenue. The market is forward-looking. It is pricing in at 2026, where GE isn't just struggling to make engines, but is shipping them at peak efficiency. When you combine efficiency with infinite demand, you get margin expansion, and that is exactly what the chart is telling us today. It is also crucial to compare how this stock behaves versus the tools most retail traders use. If you are sitting at home using SoFi Invest or checking your Schwab Intelligent portfolios, you might see GE as a boring allocation. But look at the volatility-adjusted returns. The Sharpe ratio, a measure of return per unit of risk on GE Aerospace over the last 18 months, has been phenomenal. While Robinhood crypto traders deal with 20% swings overnight, GE shareholders have enjoyed a steady upward grind that compounds wealth without the heart-stopping drops. This appeals massively to the Fidelity IRAs and pension funds of the world. They need safety, but they want growth. GE offers both right now, which is a rare combination in a market where you usually have to choose between a stagnant dividend payer and a high-risk tech flyer. Let's talk about the business model in a way that truly explains the moat around this company. The engine business is the ultimate razor and blade model. Selling the engine, the LEAP engine for the Boeing 737 MAX or the Airbus A320neo, is just the handshake. The real money, the billions of dollars that justify a $300 stock price, comes from the aftermarket services. These engines fly for 20 or 30 years. They need constant maintenance, parts, and overhauls. GE locks these airlines into long-term service agreements. Every time a plane takes off, GE makes money. Every time a part wears out, GE makes money. It is a recurring revenue machine that is inflation protected because airlines have no choice but to pay it if they want to fly. Today's intraday move suggests that the market is becoming more confident in the longevity of this cycle. With global travel demand projected to double by 2043, particularly in the Middle East and Asia, the demand for flight hours is only going up. More flight hours means more maintenance, which means more profit for GE. Comment below how many shares of GE you currently hold, or if you are waiting for a pullback to enter. I'm curious to see if the sentiment is fear of missing out, or if you think this rally is overextended. We also need to address the institutional flows we are seeing on platforms like Interactive Brokers. The options market for GE is showing unusual activity today. We are seeing a lot of call buying for the January and February expirations with strikes at $310 and $320. This indicates that traders are not just buying the stock for a long-term hold, they are betting on a continued momentum burst in the immediate short term. This aligns with the window dressing effect we often see at the end of the year, where fund managers want to show they own the year's winners. Since GE is up over 70% in 2025, every fund manager wants this symbol on their books before the year closes. This creates artificial buying pressure that can push the stock even higher, disconnected from the immediate fundamentals. If you are a self-directed investor using Fidelity Investments or SoFi Active Investing, you need to be aware of this dynamic. You are not just trading against the news, you are trading against fund managers fighting for their year-end bonuses. However, we must balance this bullishness with a contrarian take. The expectation is up only. The reality is that the aerospace industry is cyclical and highly sensitive to geopolitical risks. If oil prices were to spike to $100 or $120 a barrel due to conflict, airline profitability would crash. If airlines lose money, they delay buying new planes and they defer maintenance on older engines. This is the hidden risk that the $299.81 price tag ignores. The market is pricing in a Goldilocks scenario where travel demand stays high, oil stays moderate, and supply chains work perfectly. If any one of those three legs breaks, this stock could see a rapid correction back to the $250 level. Furthermore, there is always the regulatory risk. We saw what happened with the FAA directives in the past. While the LEAP engine is currently performing well, any technical directive that grounds a fleet would be catastrophic for the stock's short-term momentum. Let's look deeper into the engine technology itself, because that is what you are actually buying. The GE9X and the upcoming GE9X are engineering marvels. The GE9X, designed for the Boeing 777X, is the largest and most powerful jet engine ever built. It uses ceramic matrix composites, a material that is lighter than metal but stronger and heat-resistant. This isn't just cool science, it's financial leverage. These engines allow airlines to burn hotter and more efficiently, saving them millions in fuel. Because GE has the patents and the manufacturing capabilities for these materials, they have a technological moat that competitors like Rolls-Royce or